Welcome to my YouTube channel. Hi, I'm Phil Grande. I already recorded for Friday, okay, the my update to you. But this is not, and I did that Thursday, and you're going to see it today, Friday. But I also am doing now a little supplement to it to bring you up to date even further since we had the banks report today. Because I really believe we're getting closer and closer to this crash. So this is going to be a supplement to my first one that you're going to view, obviously. Okay, so you have the one I did on Thursday, which you're going to see today, and then this will follow it up. I hope I didn't confuse you. Okay, so I want to, and I think it's important to go and show you that if we go back and you look on my chart here, if you remember, when we came back over the Christmas holiday, the Federal Reserve switched from running the tech stocks up to running the banks up. And their thinking behind that was, remember, inflation is getting so bad, and that what creates a tremendous amount of inflation is every time they print money to buy treasuries to drop the yields down to push up tech stocks. And a good example is here. If you look at this chart, I know it looks like a mess, but it isn't. We'll get organized here for you. The blue line here represents, and by the way, this was given to me by Paul, one of our gang members. Did a nice job on this. So if you go back to 2008 and you see the blue line here, this identifies the stock market going up, okay, continue going up and going up and going up until we had our first correction of 20% in 2018. And then we had our second correction right here in February 2020 that they say was all because of pandemic. No, it wasn't. Pandemic certainly was triggered it, but what caused it to correct so severely is the yields are too high. Okay, the yields here are at 190, and of course, when you get yields or interest rates that high, the economy rejects it. And so, again, it collapsed. And then, of course, back here 2018, look where the yields went. And this would happen when you're running the market up. What they do is the inflation that's created from all this printing of money, okay, to drop the yields. They got to keep pushing these yields down. See it here? They got to keep pushing these yields down in order to get this market to rally, because they were using the tech stock since 2008. So you got to keep pushing it down, pushing it down, pushing it down, pushing it down, pushing it down. But the problem with that, as you keep pushing these yields down, all that printing of money is tremendous inflation. And at the same time, that inflation is like a tax, okay? It's really, and finally, the economy can't take anymore, gasoline up or coffee up 92%, gasoline up 55%, that sort of thing. They reject it. And so if you look back where we are today, when it got really critical, when I came back, they decided, let's switch to the banks over here. They said, let's switch to the banks because, remember, the banks, unlike the tech stocks need that inflation to go up. They need that printing of money to buy treasuries to push those tech stocks up, which is inflation. Banks, on the other hand, they don't create inflation, but what they do to go up is create high interest rates, high yields. They want the opposite, high yields. So I showed everybody when I came back, and I pointed out right here. I said, when this guy started to rally back up, right here like this, the banks. But what I noticed, the banks that were going up, but the trend of the banks were going down. What trend? The money was still flowing out of the banks. That's a very dangerous divergence. I spotted that, and I told my gang members I believe the market's going to correct itself. And it did. And I drew a line like this, and I said, if we break through this line right here, if we break through this line, the market's going to be in trouble. And it did. It broke right here. I was absolutely right. And I said, the other thing we need a pattern. I don't want the market to go down like this. I want to stop, go back up, and create a lower high. Here's your high, and here's your lower high. And then I want it to come back down and take this out. If that happens, then you're very close to a crash, or at least a severe correction. And guess what? What I said exactly is what happened. And here it is. It broke, went down, and then guess what? To stop it, they turned around, the plunger team, and printed money and gave it to Jamie Dimon, JP Morgan, to go in and gave it to the plunger team to go in and buy index futures to stop the market from going down. How do they do that? All that is simply they turn around and they will pretty much just say they go buy a futures, and they say, you know what, we're going to buy in 2 weeks. We're going to buy an option in 2 weeks to purchase at 484. Well, what's that mean? Well, anybody who's shorting, the big institution, they say, whoa, let's stop shorting. I got to buy my short back because they bought options. They're going to be paying $484 for this in 2 more weeks. Why would I short? And then the next day, the morning we opened up, and it dropped 500 points. And then they did the same thing. They went and bought index futures. The plunger team moved it back up. Then finally what happened was yesterday the market did what I wanted to do. It broke right here. Gave me the market did exactly what I wanted to do. There's my high. Here's my lower high. And now here, if this breaks, okay, we should have a great either crash or correction. So what I want to explain to you is this. The market is critical right now because the bank stocks aren't working because yields are too high. The economy can't accept higher yields, higher interest rates. And we saw that when this broke. They rejected it. But then we got another problem. The economy can't accept inflation from the tech stocks. So Powell's in trouble. The economy won't accept inflation from the tech stocks, and it won't accept higher rates from bank stocks. And those are two leaders. And that's why this is happening, okay? So the bottom line is this. I wanted to show you this morning because the banks opened up so poorly this morning on earnings. I said, oh boy, this could be it. So as long as you understand, every time that they tried to cut back on the amount of money they were printing to purchase treasuries to drive the yields down to push the market up because they were afraid of this inflation, which started in 2013. They panicked and they said, like they're doing now, let's taper the amount of shares treasuries we're buying. We'll cut it back by $85 billion a month. That didn't work. Within about 4 weeks, they turned around, okay, or 4 months, 5 months, something like that. They turned around and they stopped and then they drove yields back down again. Okay, they kept driving the yields back down again, and the market continued. On December 15th, Yellen says, I got to do something. So she started to raise rates. And then what happened, all of a sudden, yields started to go back up again. And this is where we got the 20% drop. Okay, in 2018, right here. Okay, that's where we got the drop right there. See it? And that became a real problem. So the market now dropped 20% because of the high yields. And then, of course, we had the rally, and the yields went up again, and it dropped here in February 2020, which they blamed everything on COVID, and which is a mess. So my point is, how are they going to continue? They said they're going to start raising rates here. Wait a minute. Every time they tried to do this, 2013, it failed, and they had to push yields down again. 2015 to 2018, yields went way up again, and it caused our crash of 20%. And then they pushed yields up again, and then we got up to 190, and we crashed again. So please, someone answer me. Why are we going to be so lucky to think that this time the market's not going to correct or have a crash when it happened each time? Two critical areas, 190 basis points right here. Yields were too high, and yields were too high. Now, listen to what I'm telling you. It has nothing to do with earnings. When you hear about all this earnings season, it's crap. Forget about earnings. You know they don't care about earnings. When you engineer the market to go up by printing money to drop treasuries to push the tech stocks up, they could care less about earnings. Okay, and here's my proof. The proof is right here. When the market went up in 2000, after the crash, had 190, the yields were at 190. They dropped them down to 55 basis point, and everybody jumped in 2020, selling their treasuries and buying stocks. Well, guess what? They had no earnings. Matter of fact, the earnings were negative 31%. In 2020, the earnings were negative 33%. 2021, the market rallied again about 35 points, and the earnings in 2021, okay, were a minus 21%. So when you listen to how important earnings season, a bunch of crap. So they were able to push these up without earnings. Now tell me, they're going to now they're saying, well, we can raise rates now, and everything will be okay. It's not going to happen, okay, because it didn't happen back here. It didn't happen back here. And every time you raise rates or yields, 300, 190, those yields went up to, it crashes because it can't accept high yields. It can't accept inflation. It's over. So let's just be patient here. They're going to do everything they can to try to push this market up. The only one thing they could try to do, but I don't think it's going to work, they could try to lower yields again to push the tech stocks back up, hoping that everybody will jump back into tech stocks. And if they do that, what they're saying is we could care less about Main Street, okay? Because here's what happened with Main Street, just so you know. We just found out the other day that the wholesalers who sell the food to your supermarket or the clothing to your favorite retail store, their costs have gone up 10%. But you know what they've been doing? Remember we got that CPI number of 7%? They haven't been passing on the whole 10%. They only been passing on 7% because they know they can't handle it. That's a very, very bad sign. So this is going to be interesting to see in the next couple of days. So I hope you learn how to short. If you're not a gang member, please and join my gang so you learn how to short. And if you don't have time to learn, then join my gang and work with Steve on the Working Investor Group, and he'll tell you when to short, show you how to do it, and just follow what he's doing. Okay, I'll see you in the charts.